Intuit closed its fiscal year beating expectations on every financial line. Full-year revenue rose 14%, while fourth-quarter earnings per share came in at $4.03, far above company guidance. For the full year, earnings per share reached $24.27, up 20% and roughly 4.5% above Wall Street consensus. Yet despite these numbers, the stock fell more than 10% in after-hours trading. The tension in the market is clear. Wall Street is not punishing the year that just ended. It is punishing the year that lies ahead. Management delivered strong current results, but the market immediately repriced the stock based on a sharp deceleration in future growth and structural strategic shifts. Looking closely at the official fourth-quarter results, Intuit generated revenue of $4.354 billion, a 14% increase year-over-year from $3.831 billion in the same period last year. This outcome topped the company's own guidance range of 11 to 12% growth. Non-GAAP earnings per share for the fourth quarter hit $4.03, easily surpassing the forecasted range of $3.56 to $3.62 for a beat of 41 cents per share. For the complete fiscal year, total revenue reached $21.448 billion, up 13.9%, which landed above the top end of management's guidance. Full-year non-GAAP earnings per share rose 20% to $24.27, beating guidance of $23.80 to $23.85. Wall Street consensus among 34 analysts had stood at $23.22 per share, meaning Intuit beat expectations by about 4.5%. The company booked $293 million in restructuring charges tied to employee layoffs, all taken within the fourth quarter. Even with those charges, GAAP operating income grew by 40% in the quarter. Performance across individual business segments for the full year showed small business up 16%, consumer up 11%, TurboTax up 7%, and Credit Karma up 20%. The steep drop in share price unfolded rapidly right after the report. In the regular trading session, the stock had closed at $357.46, down 3.37% for the day. In the after-hours session, it collapsed to $320.88, representing a rapid decline of 10.23%. The cause of this selling pressure was the outlook for fiscal year 2027. Management projected fiscal year 2027 revenue between $23.279 billion and $23.512 billion. That represents annual growth of just 9 to 10%, down significantly from the 14% achieved this year. Segment by segment, the company guided TurboTax revenue growth down to between 2 and 3%. Total consumer segment growth is expected at 4 to 6%. Credit Karma is projected to grow 11 to 13%, while the small business group is expected to grow 13 to 14%. MailChimp guidance came in between -1 and 0%. For the first quarter of fiscal year 2027, revenue is expected to grow about 11%, with non-GAAP earnings per share between $2.44 and $2.48. Understanding this guidance requires evaluating two major accounting changes. First, beginning in fiscal year 2027, Intuit will no longer exclude stock-based compensation from its primary non-GAAP earnings metric. This single change represents an impact of approximately $2.02 billion, or $5.81 per share. Because of this adjustment, the stated non-GAAP earnings per share guidance of $22.88 to $23.12 for fiscal year 2027 cannot be compared directly to this year's $24.27. This shift reflects a definition update rather than an operational collapse, but it alters how reported profit trajectories look on paper. Second, MailChimp will become its own separate reporting segment as of August 1st. Because of this separation, future growth rates for the small business group will be calculated from a base that excludes MailChimp entirely. Turning to the core tax preparation business, the underlying trends show a clear operational shift. Total United States return volume on Intuit platforms fell 2% to 39 million returns. Online returns dropped 2%, while desktop returns fell 7%. Management acknowledged directly that the company lost high-quality do-it-yourself filers to lower-priced competitors over the past year. In management's own words, price has become the number one reason customers leave TurboTax. In response, executive strategy has reversed course. Intuit will now deliberately accept a lower average price per do-it-yourself return to win back volume, retain customers, and protect its overall e-file market share. Chief Executive Officer Sazen Goodarzi took direct ownership of the setback, stating he was dissatisfied with do-it-yourself performance, accepting responsibility, and explicitly telling investors he is resetting expectations. Rather than treating artificial intelligence as an existential threat, management framed it as a distribution engine. Executive leadership argued that if disruption comes to tax preparation through artificial intelligence, Intuit intends to be the primary disruptor by embedding its tools into major external language models. The financial justification for lowering prices relies on cross-selling. Customers who use both TurboTax and Credit Karma generate roughly twice as much revenue for Intuit as single-product users. Furthermore, Credit Karma members filing taxes through that channel grew by more than 50% this year. However, this strategy carries funnel risk. 3/4 of new assisted filing customers this year originally migrated upward from do-it-yourself tools. A shrinking do-it-yourself user base threatens to eventually constrain growth in the assisted filing business, which is already projected to slow to the mid-teens. Similar weaknesses surfaced in low-end small business software, where online paying customer growth slowed to 3%. To counter this, Intuit is launching a free tier and a lightweight version of QuickBooks to capture micro-businesses at entry level. The earnings call featured detailed exchanges between Wall Street analysts and executive leadership, highlighting the primary concerns surrounding this strategic pivot. Brad Selnick of Deutsche Bank opened by asking what provides management with confidence that fiscal year 2027 represents the bottom of a performance curve rather than a permanent structural drag caused by artificial intelligence. Sazen Goodarzi answered that he is resetting corporate expectations to allow the company to play offense across two fronts. He explained that high-growth core areas like assisted tax, payments, and mid-market software already account for 30% of total revenue and are growing at 34%. He emphasized that Intuit has a history of driving double-digit user growth when focused on customer acquisition, and stated that the company will use its artificial intelligence platform to disrupt the market directly rather than yield market share. Kirk Mattern of Evercore EC asked whether lowering prices on the low-end do-it-yourself tax tier creates a slippery slope that undermines pricing power in higher-end assisted tax products. Sazen Goodarzi responded that the assisted market operates under completely different dynamics because filers in that tier pay for human review, professional sign-off, and full accountability. He noted that Intuit uses artificial intelligence to scale human experts efficiently and monetizes users across its broader consumer platform. He reiterated that because dual users of TurboTax and Credit Karma generate double the revenue, lowering entry prices for do-it-yourself tax serves as an effective, proven acquisition funnel for long-term customer value. Raimo Lenschow of Barclays noted that long-term growth targets for the business group were lowered from 15 to 20% down to 10 to 15%, and asked whether new market entrants are driving that reduction. Sazen Goodarzi clarified that Intuit is creating this pressure intentionally rather than reacting to external competitors. He explained that mid-market business customers grew 28% overall, with new customer acquisitions up over 30%, bringing higher adoption of payroll and payment services. He stated that management chose to lower formal guidance targets to grant the operational flexibility needed to compete aggressively for entry-level business users while continuing to expand mid-market relationships. Taylor McGinnis of UBS asked why online business customer growth slowed to 3% and what gives management confidence that a long runway for growth remains for QuickBooks given its current size. Sazen Goodarzi pointed to a nearly $200 billion total addressable market that remains only 7% penetrated. He noted that recent focus had been directed toward mid-market expansion, but stated that new initiatives like QuickBooks Free and QuickBooks Lite have already added over 20,000 active users in their first month, proving Intuit can accelerate low-end volume while building upselling pathways. Siti Panigrahi of Mizuho questioned how much of the reduced guidance for tax and business segments stems from actual market pressure versus internal conservatism or anticipated threats from artificial intelligence. Sazen Goodarzi answered that resetting expectations allows Intuit to maintain top-performing segments while correcting do-it-yourself losses. He stressed that assisted tax and mid-market solutions continue to compound rapidly. He stated that management is deliberately incorporating prudence into long-term expectations to ensure predictable execution while establishing a durable operational base for coming years. Arjun Basha of William Blair asked whether fiscal year 2027 provides enough time to execute this strategy and achieve a growth re-acceleration, or if the recovery timeline might extend into fiscal year 2028. Sazen Goodarzi refrained from offering exact calendar multi-year timing, choosing instead to let quarterly execution demonstrate progress. He cited existing strength in key growth initiatives alongside early adoption metrics for low-end software launches as evidence that changes are taking hold. He expressed confidence that focusing simultaneously on mid-market expansion and low-end acquisition will restore balanced growth. Intuit leaves this fiscal year having diagnosed a clear pricing problem. Management has chosen to sacrifice average price per customer to rebuild top-of-funnel user volume across both tax and basic accounting lines. Whether giving up immediate margin per user succeeds in driving long-term ecosystem value will only be proven when the next tax filing season begins.